Good morning and welcome to this week's BVTV. The last week has been quieter for markets compared to the past few weeks, so I'm taking this opportunity to share a couple of clients' most frequently asked questions. These are, have the Bank of England changed their views, and what's going on with US yields? Are we at a turning point? Starting with the US, we've heard much about fears of the Fed being behind the curve, but perhaps it was the market that was behind the curve all along. The 2018 sell-off, whilst perceived aggressively by the markets, now only brings us alongside the Fed's original dot plot. In the past 6 weeks, the US 2-year has started pricing in the Fed's expectations much more fully. Over the next 24 months, both sources are now suggesting a rate of 3%. So that's 6 hikes of 25 basis points from now. The 10-year trading at 2.9 does seem better value, but we're not pinning a consensus view on that magic 3%, where many others have been fixated. The other question I have been asked is, are we at a turning point, and is this the end of the bull market? This is going to be much more dependent upon the next inflation prints and the ability of the consumer to absorb any further rate hikes. Right now, inflation protection in the US still seems to have reasonable value, and with what seems to be rising inflation from strong wage growth data. I would have said that the dots and the market have finally aligned. Both the 2-year and the 10-year now offer better value, all things being equal. Turning to the UK, as you can see from the chart, the probability of the Bank of England hiking rates before the end of the year has increased considerably over the past few weeks. Initially, the central bank seemed to hate the idea of Brexit, but over time, and with only marginally weaker growth and consumer data, the UK seems to be in pretty good shape. In fact, the latest Bank of England agents survey suggested that pay growth has picked up and sees pay settlement rates rise to 3.1% this year. This in itself is an inflationary factor, and so perhaps the bank's earlier rhetoric of keeping rates on hold to help those more leveraged consumers has now changed. With incoming inflation, this wage data, if it is correct, and the market has found itself behind the curve, at which we have seen a distinct sell-off in the government bond markets, coupled with an increased probability of rate hikes this year. Sterling, the independent transmission mechanism, seems to me eerily strong against both the dollar and the euro. For me, there are 2 possible scenarios. The first one, the bank is correct and we have a smooth and orderly Brexit. This means potential economic growth is weaker, and as we lose cheaper labour, wages increase, causing some additional inflation. If the agent survey is right and wages do increase by 3.1% and inflation stays lower than forecast, then maybe more hikes will be needed. Hence, a more hawkish stance seems fair. Or, in the second scenario, sterling is artificially high only due to the dollar weakness. Therefore, a hard Brexit means a significant fall in sterling due to perhaps WTO tariffs. Everything gets more expensive, so import and inflation heats up. Foreign investors exit the gilt market, potentially pushing yields higher, and the Bank of England are forced to hike rates aggressively to curb higher inflation. This damages the consumer and the borrower alike. Under either scenario, there's more likely inflationary pressure on the upside with higher yields. The banks are reacting to this now as opposed to risking being behind the curve. We'll receive more news on Friday this week about the likely Brexit transition period. Thanks for watching. See you next week.